Welcome to the Black Salt end of financial year must-dos. Everyone who knows me well, I get passionate around this time of year because so many good things and things need to be happening to make sure that our businesses are, obviously maximizing our profit returns and obviously making sure from a compliance point of view, we're on point and we're not missing out on some legitimate deductions in our tax returns and obviously to save. There's one thing making a lot of money as real estate agents, but there's also as business owners being very, very financially disciplined to ensure that we're absolutely maximizing the return on our investment, time and effort. So welcome to another session of Black Salt, guys. Today we've got the great Rose Ratna from Beyond Figures Bookkeeping with us. Our staunched, she keeps us all in check with all our paperwork and so forth. So hi, Rose.
Hello. Hi, everyone.
And of course, a little bit later, joining us at 11:30 will be Sam Cimino, corporate accountant from Boss Private Clients. Sam would have to be one of the most knowledgeable people that I know in the tax planning and, of course, corporate accounts management. He's got some invaluable insights. There was a lot of, obviously, talk about the budget, and whilst we'll talk very, very quickly about a few things in regards to the fundamentals that haven't changed based on the budget, Sam's half hour will be a Q&A with myself, just really unpacking what happened on Tuesday night and what the implications are for ourselves as real estate agents, and of course, who is going to be impacted. And I've always said this is going to be an important one, and I'm not sure if if most people read my blog this morning. I put a lot of effort into this morning's blog. Thank you, Mr. Kim Turner from Tuesday, who prompted me to talk about the two buyers in the marketplace. So if you haven't read it, please read it, because it's even more important now to understand the fundamentals of the pricing of properties moving forward, because there's going to be two prices: the emotional price from the buyer, and the second price is going to be the mathematical price from the banks. But we'll talk about that a little bit later. Again, thank you so much for joining us. Everyone can see my screen. I've shared it. All good. Moving on. We're going to move on. Yep, good. A big shout out to all our industry partners. These events do not happen without our industry partners, and I'm extremely grateful for them. The collaboration that we have is absolutely fantastic, and of course, super excited for the end of this year as well, when we have our in-house conference on the 24th of November. So guys, please put it in your diaries. 24th of November is the Black Salt. It's a one-day conference. Right, this year's a little bit changed. It's a one-day conference in-house. Some phenomenal speakers already in the lineup. Then for our AA members, we have our 20-year gala anniversary the night after. So please ensure you are all prepared for that. And then our implementation day is going to be a week later. So based on feedback that we had, and it will be a virtual, to actually have an implementation day for our PB, our personal bests. So super excited, and a whole bunch of stuff happening. Okay, disclaimer. Please read this. The information provided in this presentation is general in nature only and does not constitute personal financial advice. So very, very clear on that. And I'm going to go straight into this one. All right. Yes, we have an accountant with us today. Yes, we all need a professional advisor to help us navigate the rules of engagement with the Australian Taxation Office and to meet our obligations. Yeah, everyone's aware of that. Okay. But if you have to wait for your accountant to tell you you're in profits, it's too late. I am telling you, it's too late. What do I mean by that? I mean that every single business owner, and I want today's session to be the lead up to finishing the financial year strong, right? With knowledge as much as obviously a great P&L and a group certificate, but with the understanding if you haven't been doing this, this is your year to do it. There's always going to be a penny drop moment for anyone that comes to these training sessions where you may have heard this before, but you actually haven't actioned it. Today, I want that to be actioned. No excuses, not waiting till next year. I was just mentioning to Rose how quickly 1 year has passed. And it's just like that. I mean, look, just show of hands, I guess. Who was here this time last year at our end of financial year? Yeah, a whole bunch, right? So if you haven't implemented, you need to implement it now. Okay, so fixed expenses, fixed and variable. You need to know your fixed expenses. In all my business planning sessions, I always talk about, is it $1,000 a month? Is it $2,000 a month? Is it 10? Is it 15? Is it 20? Whatever it is. If you do not know what your fixed monthly expenses are, when you leave today, that's your first action list. Your break-even point, which is including your fair profit margin. So your break-even point is, let's just pretend you've got 10,000 in fixed expenses and you need personal expenses of $10,000 to live, and you want to make another 5,000 in profit. You need to be doing 25,000. That's your break-even point and your margin for your GCI. Okay, so it's important to understand that. This one's a good one. Operating in code red. It's funny, right? And it happens to us just as much as it happens to every business. And the larger your business is, the more important this code red means. What it means is that when there's a financial shift, so the market's going really strong, whether it's in retail, whether it's in property, most businesses have great cash flow and they suddenly add expenses that they don't necessarily need in their business. It's the feel-good expenses. We're guilty of it, absolutely 100%. And then suddenly when the market shifts and 10, 20, 30% of our revenue drops for whatever circumstances, we go into code red. And then we bring up our subscriptions, we bring up this, we bring up that, and then we start cutting, right? My suggestion is to everyone is on a monthly basis to always review your fixed expenses, right? And make sure you're getting a return on investment, whether the market is good or whether the market is crap. Because if you have to wait for the market to be crap before you remove an expense, why did you have it in the first place? Does that make sense? And I think we're all guilty of that, right? And we see it all the time in headline news that major corporations, oh, we just wiped off 1,000 employees, or we just got rid of this, or we got rid of this plant and so forth to reduce expenses. And I'm always curious, wouldn't it be great to be doing that always, even when the market is hot? And of course, cash flow analysis, cash is king. People totally underestimate there is a fundamental difference between P&L and cash in the bank, fundamental. And we need to understand what that means. I always go back to my fixed expenses and my variable expenses, and I always say during the month, and I do it today as I did it at the beginning of my real estate career in business, and we did it in our hospitality business. And Arthur, when was our break-even point when we're running the hospitality business? We're running a coffee lounge. I remember at Moose's, our first business together, good old 40 years ago, Arthur.
It was unfortunately, Manos, it was about 12 o'clock on a Saturday.
And we were trading till what time on a Saturday?
Well, back in the early days, it was about 1.
Yeah, and then they shifted the trading to 5 o'clock in the afternoon, and our profit was made between 12 o'clock on a Saturday for the whole week. Our week finished, it was Monday to Saturday. We weren't trading on a Sunday. And our profit was made 12 to 5 o'clock. So it took us 5.5 days to get to the break-even point. before we're in dollar for dollar territory. And trust me, when it came to 12 o'clock on the Saturday, and then we saw the shop filling, we we're pretty excited because we we're going to make some money that week, right? When it was quiet, we're going, we just worked for nothing, right? So it's critical to understand this. Okay, moving forward. So volume is vanity, profit is sanity, right? So end of financial year must-dos. We need to review, reset, relaunch, what worked, what didn't. Return on investment in the marketing and advertising, guys. Like, that's so critical to understand. You don't just throw money at marketing initiatives, right? Without measuring the return on investment. So any marketing we do, obviously to build our business, my team know I need a report on a weekly basis. I don't wait till the end of the month. How much money did we spend? Are we spending $50 a day on socials? Are we spending $100 a day? What's our lead generation? Where else are we spending money on lead generation? And what's our return on investment, right? So it's critical to understand that. Of course, how much profit are we on track to make? Benchmark on prior years or industry. Now, every business is different, and real estate is one of those beautiful things that you could have a really lean business, right, operational, and your margins are huge. And most of our AA members who are on today would understand that, because you're not carrying a lot of overheads like the traditional. That is a really big tick. So it's pay on demand, and those people not part of AA, and it's not a plug for AA. I'm just want you to be aware that you need to structure your business to understand your profitability, especially when the market is on an increase and the market is on a decrease, and benchmark it against prior years. The average business in Australia today in real estate manages 10 to 15% profit. That's taking everything into consideration, right? That is taking your wages into account as a sales agent, as a director, if you're the owner of the business, all right? And most businesses in Australia today, if you're running at a 10 to 15% profit, you're doing really, really well. Anything above that, it's a big tick. It's a huge tick. And benchmarking is important because, look, I'm a great believer in the law of probability. The law of probability means that the market finds its forces, supply and demand curves naturally find their level. It's like water always finds its level. Very rarely would you find a unicorn business that's making over 50% profit on their turnover. And it's because market forces, i.e. competitors, come into the market and then they start attacking everyone's margins, right? So benchmarking is a really good KPI to measure your business against. And of course, it's not often talked about, but work-life balance. And it was one of the topics I spoke about with Sam this morning on a half-hour call that I had with Sam Cimino. And ourselves in real estate, guys, I can't tell you, having been exposed to so many businesses out there, nothing comes close to the work-life balance that we have in real estate. So be aware of that. Okay, now over to Rose before Sam comes on. Enough talking from me. Rose, welcome today.
Thanks, Manos. Hi, everyone. For those who don't know me, I'm Rose. I run Beyond Figures very proudly for the last 10 years. And I'm the bookkeeper for a lot of you that are online today. So when Manos reached out again this year and he said, let's go again, let's try and explain what is the role of a bookkeeper and how we help the accountants principally to get your tax return out and what we do. I wanted to touch briefly on how the role of a bookkeeper has evolved. Pre-COVID, we were quite clear with the delineations. Okay, this is what a bookkeeper does. We plug in numbers, we produce, and Everybody is happy. Since COVID happened, accountants have a lot more work. And so the work's been pushed on bookkeepers to maintain a higher consistency, higher standard of what we're delivering on every day. So a bookkeeping office is pivotal now in terms of how things happened. No longer is the time when I used to push buses and I'm like, my buses are done, I'm done. Now it's more an engagement with every single client, looking at their profit and loss, closer to the financial year and looking at where they are at, what's happening. You're in crisis. How can I help you? So bookkeepers is like a strategic ally now compared to where it was 6 years ago. And this has shifted a lot of how responsibilities we have here in this office and how we are working pair in pair with a business owner, doing meetings, because you need to understand very often the accountant sees the books, the file, the client once a year at most. But the bookkeepers are there every day. They are the ones that are going to raise the red flags. They are the one that's going to come and tell me, I think you need to help this person. So this is where the involved, I guess, work has happened for the last 6 years. And Beyond Figures is very much part of that. I'm quite proud to say that the girls here and the boys, the team, look into every single person and not just do. It's so easy to just do and forget about the basics of why are we bookkeepers. So it's about helping each and every one of you to feel confident in what you're producing. It's important to know that we are here to back you up on every angle. So a few things that obviously bookkeepers
and Rose,
do.
if I could just, and I know time is going to be precious today, to trying to cover everything off. But even from a real estate agent's point of view, I want everyone to understand what Rose just described, a shift in her profession from being, for lack of a better expression, data entry people to actually data entry and strategic advisors, obviously not at the level of an accountant. So, just obviously the disclaimer there. But can I tell you, they're in the field. It's just like us in real estate. We no longer just transact homes, list and sell homes. We're project managers. We help manage the whole sales process. Psychologists, sometimes the whole lot, right? So even our roles have evolved. So, and this is from industry to industry. So just be aware of the comparisons of bookkeepers and obviously ourselves as real estate agents from a client services perspective. Over to you, Rose. Sorry.
That's all right. So now you can see the few things that needs to be happening for you to be ready for 30 June. Namely your banks. It depends who does your book. If you do it yourself, then please follow those instructions there. Every bookkeeper out there knows to follow those ones, which is make sure your bank's aligned. Hence why I know a lot of you get an email saying, can I have your bank statements? We just make sure everything is set. The next one is accounts payable. We make sure that pretty much if you covered the bills and everything like this, because some of the impact of you not closing up things means that you have a distorted profit and loss that's being produced if the data that's been entered is inaccurate. So there's a sense of relief when we know, okay, this has to be sorted now. There's a sense of understanding on how you're going. How can I have no money in the bank? Those are the questions we have very often from clients. Where is the money gone? So it's a lot to do with poor recording. We inherit a lot of files. We can see things that are incorrectly being done. And so the focus on Beyond Figures is making sure that your reporting, which is extremely important for every businesses, is 100%. I know the girls here, they stress the fact that this is incorrect and everything, but the purpose of all of this is to make sure that when you're looking at your profit and loss, it makes sense and that it's reflective of where you want to be. So accounts
and can I ask, Rose, do you liaise a lot with obviously the accountants as well? So
Yes,
Is
we
that your
do. On
role as
every
well?
onboarding, we do request the email of the accountant. Like I said, accountants are extremely important to make sure that everything's being followed.
Yeah.
But Manos, I'm sorry to say, they have 5,000 clients, and it's impossible, as big as it could be, to try and get to everybody every time.
Yeah.
So we are a bit like the minions, going out there, making sure we're into that file. I'm warning accountants all the time. I'm telling them how this is not right. Or I will email someone, I'll go, you have to have tax planning this year. I guess I'm giving them bad news and good news. The good news is you make a lot of money. The bad news is the taxman's going to come for you. So please see your accountant. So these are the things that we discuss. You know what I mean? Pre June. There's no point in you not knowing where you are at before June, and then it's July, and then you go to see the accountant. There's nothing you can do, really. So it's important for you to have a tax planning session in March, April, May, where you decide what you have to do. The government's giving some incentives recently in the budget, the $20,000 instead asset write-off. What are the things you can do to help grow your business? Do I need a printer? Do I need a computer? Do I need whatever you need that is actually tax deductible that you have to be done pre-June? These are the things we point the client towards, and we also let the accountant know, or let them know if we don't have the contact with the accountant, go to see the accountant.
And it's fair to say, Rose, that yes, you wait to the end of the financial year for certain things, and I'll probably jump onto your case study and then obviously the next slide as well. So it's the key fundamentals that everyone should be aware of before the 30th of June, because there's some trigger points that obviously if you don't, for example, submit your super money in time, you actually don't get a deduction and a possible penalty. Would that be right?
Correct. Payday Super is starting 1st of July, and everybody is aware that now the government means business. They want the funds to be given to the employees on the go. So if you pay late, if you pay your super late, auditing via the tax office has ramped up by 40%. A lot of money has been given to the ATO to do this. Just to give you a scenario, this particular client owed $19,000 in super. And the penalty and the rates and the interest and everything after the audit resulted in a $60,000 payment.
Can you say that again? Because I think everyone needs to understand this one.
So the client got to us late. We tackled the things. The person were doing their own bookkeeping. Bless her, she tried to do the best she could, and we went in, and the super rate that's changed hasn't been captured in the system. We ran the audit. She was flagged for an audit because the ATO saw something was wrong. They are so smart now. They identify anything that's out of whack, and you get an email, you get a letter. And so it took us 6 months because it had 4 years.
Wow.
And it's $19,000 of super with a penalty, the interest, and the admin fee. She had to pay $60,000. She's in liquidation. So it's just so important. Unfortunately, this client we could not help because they came after the fact. After the fact, when the accountant flagged it, when they went to, and then the accountant referred us to try and resolve the matter, but a little too late. So, and this is what Beyond Figures do day to day, every week. We're actually in your emails, in your phone. We're trying to make sure that you're up there. Is a cash flow issue? Talk to someone. Talk to me. We've got a plethora of people who can help you get finance, get help, so that you don't have this situation happening. It's not worth it to lose the business you've set up for years and years on the fact that you have late super or whatever the penalty is, or late buses or anything like this. So do you want me to carry on?
Yeah, so if we could just go through these 4 strategies, Rose. So strategy 1, before the 30th of June, prepay business expenses. And Sam will probably talk about the $20,000 write-off. You can do small equipment, and that's permanent now. So that's a really good thing. So again, looking at your cash flow, looking at if you've got some cash in the bank and some profits, and you want to minimize your tax exposure, this is a good way to bring forward some expenses, which is fantastic. Strategy 2, maximize super contribution. So Rose, do you want to just share something that someone can do here?
So definitely super contributions is critical by 30 June if you want to claim it in the year, especially if you have profit in the year. It's very important that you try and see as best as you can, if the cash flow permits, that you try and pay the super before June end. It's actually very good to have the deduction now. And also because 1st of July, super is on the go, which means you're going to have a June super and a July super mixed into each other, and then that can cause cash flow issues. So try your best to talk to your bookkeeper and try and push all the super prior to June 30.
And on an individual basis, Rose, right, before obviously you got to pay the top-up tax, because at the moment super is being taxed at 15%. What's the maximum an individual can put? Is it 25,000 or is it
30,000?
It's $30,000.
Yeah.
So guys, just to give you some maths on this, right? Now, depending on where you are in your life as well, right? Whether you're just starting and you're in your early 20s or you're in your twilight years, is what we are, right? This is not a strategy for everyone, right? So because sometimes cash is always king, because once it's in your super fund, it's in your super fund, right? You can't get it back out. So just be aware of it from a timing. And again, that's why your bookkeeping, your accountant is just so important to understand, because if you put an extra $10,000 into your super fund, just some raw maths, guys, if you put that straight down to your group certificate, you're likely going to pay another $4,700 in tax, depending on your tax brackets, but it could be that high, right? Or 45%, 4,500. If you put it into your super fund, you're only paying 15%. So you're in front by about $28,000, right? $2,800. You actually save that money, right? Yes, you don't have that disposable income of just over $5,000, but it is a really smart way to actually build some wealth that you can use a little bit later. So just be aware of that. Okay, strategy 3. Pay staff super before June 30. This is so important, isn't it, Rose? I see so many businesses fail to do this. And what happens if you don't pay it by June 30th?
Well, the problem is the deduction is not allowed in the year. You got to wait to the next year. And if you're in profit, that really hurts, because you're actually going to pay taxes on money that you actually should have paid. So absolutely, to mitigate the taxes, I would strongly recommend paying that before June 30. Yeah.
And of course, strategy 4, don't get caught by Division 7A. Arthur's going to get some number plates called Div 7A. For those who don't know what Div 7A is, and I'm not sure if it's changed now because of the budget, be aware of it. If there's anything that I've understood coming into the real estate industry, Div 7A, obviously strategies have caused a lot of businesses a lot of pain. And Division 7A, without trying to obviously talk about the accountant's role in this, is where you structure some profits from your business as loans as opposed to drawings, so you don't pay the top-up tax. But of course, there are special rules around that, because eventually you have to, right? Eventually you have to, either it's a Division 7A loan, you actually have to pay the tax on it and treat it as a loan. So it is a little bit, well, it's not that complex. It's very easy to understand once you understand it, but most people go to their accountant. Their accountants do this without advising correctly to their clients. And they get caught out, and you get caught out 5 years later, guys, and it can be catastrophic for some circumstances. And you haven't done anything wrong. You've just followed the guidance of an accountant who may not have guided you that well. So please, if you don't know what Division 7A is, the first question after today's session will be to ring your accountant and to say, right, do I have any Division 7A loan exposure? And if they say no, make sure you have it in writing. And if they say yes, you need to book a time with them to totally explain it, to totally explain it. So, okay, so moving forward. So, have we got Sam on? Do you know if Sam is on?
No.
Reed, do you want to just SMS, just make sure that he's got the link and so forth. So, Rose, since obviously the federal budget, from a bookkeeping perspective, is there anything that you will be telling your clients? What is something that a client is not likely to know right now in regards to their bookkeeping side of things? Is there anything in particular?
More the fact that, especially in real estate, you're going to be quite conservative. I can see through our files that we can see the day-to-day, the cash flow is a major impact, right, on the day-to-day business and day-to-day decisions. Everybody's still digesting the budget. It will take people a week or two to come and understand what that means. But the ramifications of this is we might be having okay year this year, but next year going to be harder.
Yep.
I would say to all real estate agents, just have a tax savings account. Have a tax saving accounts that you're not touching, that you're putting the money away. All the clients that are beyond figures know the rule. Have at least 2 to 3 bank accounts. One that is not my money. And I say it is not your money, because they will go and pass on. Whether you save those things on the go or in lump sums or whatever you can, will help you identify that, okay, this is the funds that I have available to grow the business, and this is the funds that I have to pay the tax office. Because though they are lenient now since the war in Iran, that's fine, but the leniency comes and goes. And you'll have the period when they come for you. And via the accountant or to yourself or to us bookkeepers, once this leniency stops, they will come for you. Always be prepared that you have those funds stashed away, and that way you're not misunderstanding that those funds are up there to be investing anything further, computers or whatever you want to purchase. Just make sure those funds are stored away. Of all the clients that follow that principle, I feel they are much better placed when it comes to paying taxes.
Yeah, I definitely agree there. Right. So and I've just stopped sharing because I've seen that Sam's come in. Guys, what Rose just shared is financial discipline. What she just shared is that all the money that comes into our bank account is not all our money. It is there to pay expenses, certain expenses, your PAYG, your staff superannuation, all those things. So by separating it, it gives you a snapshot without going into the balance sheet, without needing to go into your P&L to say, okay, this is available funds. And when you do that, you can actually make better decisions for your business and understand your business. Because when I see business owners and they see, it's very easy to get $100,000 saved in your bank account, but when you realize 50,000 of that is not really yours, you have a different perspective on it and a different respect for managing a business. But Rose, thank you so much. I know the team, you're a raving fan to so many. So thank you so much for everything that you do for us. As your business says, Beyond Figures, that's the title of your business. You go beyond just figures. And absolutely invaluable. So yeah, sincerely, thank you for everything that you do for our clients and obviously your personal clients as well from Beyond Figures. So yeah, big shout out to you. And
thank you, Rose.
Yes, 100%. So virtual clap from everyone.
Thank you.
Now, we've got the man of the moment, who's come in after probably the biggest 72 hours since the federal budget. Sam, I can see that you've come in as Delaney, but that's okay.
Yeah, it happened to me as well. I'm not sure why.
Yeah. So that's okay. So if I think we've got you on mute. So can you hear us now, Sam? Can you hear us? Yes, no, we can't hear you.
It's okay, he's getting...
Okay, we got the IT person in. So yeah. So just by way of introduction, team, Sam Cimino is a corporate accountant from Boss Private Clients. He has been agency corporate accountant for the last 4 years. And again, I've always said, whilst I'm a big believer, yes, we can hear someone there. Whilst I'm a big believer in you, if you have to wait for your accountant to tell you you're in profit, you're in trouble. You need an accountant in your corner. They're part of your professional team. They're part of your business. They're not a service provider. They are your business partner, an essential business partner to ensure that your tax planning, your structures are correct to maximize legitimate savings and, of course, building wealth in your business. So, Sam, a huge welcome again. How are you, buddy?
Oh, good. Sorry, I've just managed to get connection because I couldn't hear you. All good. Lovely. Thanks, Manos. How are you all?
Yeah, we're fantastic.
Thanks for joining us, Sam.
Well, I should say I was better. Sorry, I was fine until yesterday because it's all come crumbling down on us, and there's a lot of anxiety out there in terms of the changes, which I'll sort of walk you through in a moment.
Yeah.
Anyway.
Well, okay, so let's start. Look, we've gone through some of the basics in regards to obviously every business owner being aware of what to do by the end of 30th of June, the fundamentals, making sure that all your invoices are paid, taking advantage of some capital write-offs under the 20,000, all those sorts of things. I even talked about the super, talked about maximising super contributions, and don't get caught by Division 7A. And yes, Sam, I made a disclaimer that I'm not an accountant. It's not advice. So we've gone on the right foot. But I think for the end of this session, I think it's important just to focus on the federal budget, what it actually means, and to have some sort of indication of what it means from a business perspective. Are we going to see an increase in turnover, decrease in turnover of our volumes, and the shift in the market potential market stakeholders, and more importantly, from my perspective, to the whole wider real estate team and to anyone, I am a true believer we need to learn the rules of the game. And once we learn the rules of the game, we've got to play better than anyone else. These rules are going to come and go. We just got to understand them, not find ourselves in a panic, not find ourselves in a shrinking mindset, just to say, okay, there's going to be some winners and losers on this. I choose to be on the winning side. What do I need to do to be on the winning side? Okay. And if it's as fundamental, Sam, as this, just make more money, pay a little bit more tax, and just get on with it, then it will be that. Do you know what I mean?
So that will be it. Absolutely. No, it's all good. So look, I think let's focus on the positive stuff first. And I was quietly surprised because we all, the scuttlebutt, leading up to the budget, there was so much rumor mongering going on about, is the discount going to be dropped to 33%? Is it going to be 25%? Is it going to be zero? What happens? Is it going to be grandfathered? Is it not? And that created a lot of uncertainty with people, right? The great news is I think they've done the responsible thing, and I've got to give them credit where it's deserved. So yes, the discount is going, but the great news is there is a grandfathering provision there, and basically they're saying that they're going to allow property asset owners, because it's not just in relation to property, it's shares, it's all CGT assets. You're going to get the opportunity to revalue that asset as at 30 June 2027, and that becomes the reset cost base for a potential future CGT event. So just a very simple example. If you bought an asset 20 years ago for $100,000, if its market value at June 2027 is $2 million, and you sell it 12 months later, let's call it in the 28 financial year, for $2.1 million, under that scenario, the difference between the $100,000 and the $2 million gets taxed under the old rules, so you still enjoy the 50% discount on $1.9 million worth of gain. I'm providing an extreme example.
Yes. Mm-hmm.
And then the $100,000 gain that occurred post June 27, that'll be under the indexation rules. And I think the positive about that is that it's not going to create this massive panic, because if those rules had been that, you know what, you've got till June 26 to sell all of your prior properties, you can just imagine the frantic panic in the market.
Yes.
And the fact that you're allowed to reset your cost base is brilliant, right? I mean, if you then get an inflationary increase as a result of whatever the market value is at June 27, well, it is what it is, right? And it's what the system used to be. The only slight bit of bad news is for anyone that held, and there would be few and far, I think there would be few, but anyone that holds a pre-capital gains tax asset, an asset that was bought before 19th of September 1985, it loses its pre-status. So it falls under the same banner. You get the opportunity to revalue it at June 27, and that becomes a reset cost base. So whatever it's sold for subsequent to that, the gain will be on the difference between whatever the market value was at June 27 and the indexation post that.
Mm-hmm.
So that they're probably the worst losers out of this arrangement. Look, so I think we can all live with that. I think there's not going to be a mad panic in the market. You'd like to think there's going to be some rationality going on, and like everything, you're right, Manos. There's always going to be change, right? You've got to embrace it and not let it defeat you, is my view also. But otherwise, you're going to be combated for no reason.
Mm.
The other positive that I think is, and this is, I'm not sure how it'll play out in the property market, and no doubt you've all heard it, that the negative gearing incentives will only be applicable in respect to new acquisitions. It's going to be great for builders. You'd like to think it's going to be great for creating economic activity. You'd like to think. It's not all terribly bad. If you buy a second-hand residence, now we don't, and I'm not clear, and I don't know the answer to this yet, whether if you hold an existing asset, second-hand residential property, whether the gearing continues, and I'm not sure whether it's in respect to any new acquisition. So if you bought a second-hand property and sought to gear it, all it means is you don't lose the gearing benefits. It means you can't offset it against your other income. So that loss gets carried forward. It gets quarantined. So a negative gearing property loss has to be offset against a future property income. You can't offset it against your salary and wage income or your business profits. It's just quarantined. So
can I just ask on that quarantine? So let's just pretend an investor buys a property. 5 years later, let's just pretend $50,000 has been quarantined. That's the losses, right? But he sells the property. Is he able to
offset it against the gain?
Against the gain, because that's a capital gain. You can do that against the gain.
Correct.
So if they made a $300,000 gain, right? But a 50,000 negative gearing. Well, it's not negative gearing.
You'll pay tax on the 250.
You only pay tax on the 250, and that will be the capital gains tax.
Correct.
Yes. Okay.
Correct. So
that will also be adjusted for inflation and all those.
Correct, and then correct. So yeah, that's exactly right. And again, I'll repeat, I'm not sure what happens with existing holdings.
Mm-hmm.
The detail that's lacking that we don't have yet is what is considered to be the definition of new residential premises.
Mm.
The feeling out there seems to be that they're probably going to follow the GST definition,
mm-hmm.
and under the GST definition, but they may not, right? But under currently the GST definition is if a builder builds a property, the first sale to a consumer, that's a sale of new residential property. When that consumer then on-sells it to another party, that's now the sale of second-hand residential property because it's already previously been sold, right? We're not sure if they're going to adopt the same principle or not. But, they could adopt an aging principle. They could adopt and say, you know what, if you buy a property that is not more than, it was only built within 5 years, that may still consider to be new residential. I don't know. We're doubting that, because if you read in between the lines, what they're trying to encourage economic activity, right? So they would much prefer that if you're going to, and I'm going to share some interesting stats with you with a client of ours who's doing a major subdivision, which really threw me in terms of stats. So yesterday, amongst 3 million other calls I got a call from a client who's doing a substantial subdivision out at Morwell, of all places. It's land subdivision. And he said to me, Sam, you'd be really surprised to hear that none of our sales to buyers have been sales to home owners. They have all been investors. And I go, and it's funny, and then I shared that news with another client that we act for, and he said, "Yeah, I don't. That doesn't surprise me." I said, "Why doesn't it surprise you?" He said, "Because if you think about it, the fact that rents are going up, and rents, whether you're in Morwell, you're in Melbourne, you're going to get a better yield on a lower capital, on the acquisition of a lower capital asset value. You know, surely a home in Morwell is going to be cheaper than a house in Melbourne. So it actually makes great sense from a return perspective. And so, look, and that might be the motivator, but I was actually really surprised when he told me that all of his purchases, and I forgot to ask how many, but, you know, I think the subdivision's, 300 or 400 lots, right? All of the sales have been to investors, which is an interesting statistic, right? Which I thought would be really good practical knowledge for you guys being in the space. Now, how that translates moving forward. Clearly, I think it's positive that we're trying to encourage economic activity, and if it means that builders get on their bike and people keep, participating and wanting to buy a new residential property, it's probably not a bad thing.
Yeah, look, supply, Sam, for me, being in the industry for 23, it's all about supply. We see it in a micro level, in a local area where the same product and lots of the same product comes onto the markets. It favours the buyers. In other areas where there's a low supply, it favours the seller. So supply and demand. And my perspective as well, and I listened to a podcast yesterday, just a brief one, and Maria shared with me, and where a financial advisor and investor said, mate, losing property under negative gearing was never a great strategy in the hope that the property actually increased in value. The best strategy is always to have positively geared properties. I do believe it's going to affect the rental market until supply is saturated,
catches up,
which is very, very unlikely. So rents are going to go up. So the biggest impact I feel from the budget, and it might be my contrarian view, but I think renters are going to be massively impacted.
Well, I think, and it's probably fair to say, sometimes you've got to take with a grain of salt the stuff that appears on social media, because you don't know where the data's come from, right?
Yes.
But if what I've seen come up a couple of times, they're saying it's already happened anyway, regardless of these budget changes. They're saying that, and it's probably been more driven by the holding costs, such as land tax. But they're saying something like 24,000 in Victoria alone. People have withdrawn about 24,000 homes out of the rental pool, and they claim that comes from whoever the rental bond body is that collects the rental bond, right?
Yeah.
And so that if that's not bullshit and it's true, you'd like to think that there's validity in that. But with already, if you've, because they're saying all of the buyers in that space, the people that are selling those investment properties are owner occupiers, you've already created a massive shortage in the market. Now, I suspect that you guys would be seeing that firsthand. You must, I presume, the rental market is still strong. Because there is a demand for people having to live somewhere.
Oh yeah, on the pressure on rents going up. Absolutely.
Vacancy rates are very low. Like there's
so you do confirm that across the board.
Yeah, I mean, Arthur will be the best person. I don't think our vacancy rates are very low, aren't they? Like we put them on and they go out zero.
There's zero. Yeah.
Yeah, and the rents definitely have gone up.
Mm.
Yeah, look how that plays out moving forward. I suspect the challenge is going to be, of course, and if you speak to any builder, is that a lot of domestic builders are struggling to make how a domestic builder in this market can provide a fixed price to somebody, and and the fact that it might move in 3 or 4 months, that's probably the builder's biggest challenge, and I do feel for them.
Yeah.
Maybe what happens is we're left with a handful of major players like the Metricons of the world and the Henleys of the world who have really big balance sheets behind them, right? Probably not a bad thing, but I think that we'll watch this space. Okay, now the cliffhanger, the major change that is going to cause us potentially all a bit of grief, and if it's not reformed or not adjusted moving forward. So the big one that was probably silent and they've hit us by left field, that's sort of kept me awake at night because I keep thinking of alternatives and people that affects and how we. So taxing, they've now finally decided that they're going to tax from 1 July 28. They're going to tax discretionary trusts, and in contrast to a fixed trust, and we'll talk about that in a moment. As so currently, what happens if you've got a trust? The trust itself is never liable to pay tax unless it accumulates its income. The taxing point has always been in the hands of the ultimate beneficiaries. And one of the reasons trusts have always been favoured is that you talk about this flow-through effect. So if the trust makes a $10,000 profit, the taxing point is not in the hands of the trust, it's in the hands of the ultimate beneficiaries. So if I can just give a really simple example, mum and dad own a rental property. Let's assume that after all costs and have been taken out, that there's a profit in that trust of $40,000. Mum and dad don't have any other income. Under the current rules, they get a $20,000 distribution each. There's no tax at the trust level. When it gets to mum and dad, because they're under the $20,000 threshold, there's no tax at mum and dad level either. Very simple. What they're proposing, and I actually don't have an issue with the trust being taxed. That's not the obstacle. The obstacle here is what they're saying is, in the new world, if I give you the same example, trust makes $40,000 profit, it'll pay tax at 30% flat rate. That's 12 grand that goes to the government. When that gets distributed to mum and dad, the fact that they're under the $20,000 threshold, the government's proposing not to give them a credit for the $12,000 the trust paid, which means, correct, that hurts, right? And it's going to affect people at the lower to middle income level more, because the break-even point is about $200,000. So if I change that example and had that trust now earn $400,000, mum and dad have no other income. The trust will get taxed at 30%, which is 120 grand. Mum and dad get $200,000 each. Because the average tax that mum and dad end up paying is, it averages, when you work through the marginal rates, it averages at 30%. They get a credit for the 120,000 or 60 grand each the trust paid. No difference, right? In that case, it's unaffected. But you can see there'll be a lot of people. Even driving home last night, I got a client she's got 3 or 4 different trusts with different rental properties. They don't all yield a lot of profit. All of those trusts are going to get hit at the trust level, and potentially, if their income tax liability in their hands is lower, you're going to get smashed. Now, there's further bad news. So that's in the case where a trust distributes to a natural person. The thing that they've really hit on the head with a hammer, or a sledgehammer, I should say, is, same example, that same trust has got $40,000 profit. Instead of distributing, it might determine that it doesn't distribute to mum and dad because they've got other income. And if they get the distribution, they're going to pay tax at 47 cents in the dollar. So what currently happens in our current world is you look down the family tree and you go, okay, well, maybe there's an opportunity to distribute to a company who's going to pay tax at either 25 or 30%, because that's going to be better than giving it to mum and dad at 47.
Mm-hmm.
Where a discretion moving forward, they're saying after 1 July 28, so it's a couple of years away, they're proposing that if a discretionary trust determines to make a distribution to a corporate beneficiary, not to a natural person, regardless of the tax liability of the company does not get the credit. So the trust pays tax at 30%. The company then is liable for another 25 or 30. That company is either going to pay 55% in tax or 60%.
Ouch.
Now you might say, well, look, it's simple. It's a discretionary trust. You just don't distribute to the company. You're fine. The problem we've got is, in a lot of examples, you will have situations where mum and dad with ordinary businesses are probably running those businesses out of a discretionary trust. And they may decide to, again, depending on what the needs are, some of it goes to mum and dad as adults, and some of them might go off to a corporate beneficiary. And that corporate beneficiary may then go off and buy a rental property or do something of some nature. Under these rules, that is no longer a viable option. Now, that's okay with new acquisitions. You might say, okay, well, we'll structure around it. The problem is if you're in an existing arrangement where that company, for example, and I'm going to keep it simple, that company's already undertaken a commitment, it's already got some gearing losses in it because it's bought a rental property and it's got some debt. And we're now looking to offset the profits that the business makes by distributing to the company. You are going to get smashed. In fact, I can't think of a way that you can get the income across from the trust to the company. It's really problematic. Now they're saying that they're going to provide, and they're going to talk about providing rollover relief. Now there are currently in the CGT legislation, there are various times that you can roll an asset over from an individual's name or a trust to a company. But those provisions are very, very prescript. And if you don't dot the I and cross the T, and you get it wrong, you end up in a world of pain. Let's assume that there's some form of rollover relief from a federal government perspective. The problem you've got is if you've got a company that's got a property in it, or you've got a trust that's got a property in it, and you seek rollover relief for federal government purposes, do not think that you're going to get concessions from the state government for stamp duty. That's going to be the problem, right? And history has shown that the states are not going to suddenly play ball and say, okay, you've decided now to restructure that property out of the trust into the company. You've got CGT relief, but I can tell you we're not going to give you rollover relief. And I've experienced that firsthand with a complex matter we had a few years ago where we applied for a private ruling to the tax office and said, look, we've got a trust here that we want to vary it from a discretionary trust to a unit trust. And we wrote to them. Believe it or not, I was actually very surprised. We actually got the ATO to concede and said, yes, we'll give you rollover relief under those circumstances. Mm-hmm. And we had, in this particular case, it was two properties, one in New South Wales and one in Victoria. Both the New South Wales and the Victorian revenue officers wrote back to us and said, look, we're not going to give you duty relief. So we went back to the client and said, well, he ultimately decided, that the cost of the duty was too great, so we didn't proceed.
Mm.
Look, that's what's been keeping me awake at night, and look, and I'm sure every other accountant in Melbourne, because it's one thing to, and I've, with a few clients I said, look, who are about on the brink of making an acquisition, I said, look, just hold fire before we set up the structure.
Yeah.
You can still change the course of the future, but with stuff that's already embedded, I mean, every time I think of another case, I just have another nightmare because it's difficult to change some of these arrangements. So yesterday I was on the phone with a lawyer who's a partner in a legal practice. That practice is a partnership of discretionary trusts. Currently, in that arrangement, we've got exactly that scenario happening. He gets a share of profits from the practice. His discretionary trust then distributes to him and the wife and to a corporate beneficiary, which has a substantial investment property, which is geared.
Wow.
And I just can't get my head around how we're going to get the profits across to, he said, will I lose my gearing losses? I said, potentially, yes.
Which means it makes the purchase unviable in some circumstances.
Well, the problem is he's half pregnant, right?
Yeah, that's right.
In this particular case, it's a property that he bought for $4 million, and I think the new build. Look, they're big numbers. The new build $7 million. We're talking about an $11 million asset.
Yeah.
The debt's 4 or 5. For not to lose the benefit of those gearing deductions simply because we can't move the money from the discretionary trust to the corporate beneficiary because they've completely hit that on the head is a major challenge. Now, I hope to God that today it's funny because a client I act for was a politician. He said to me, when I explained those rules to him, and he didn't know himself, he said, look, they've got no idea themselves. It's really bizarre. He said Manos, I've got to tell you, it would make some of the questions this guy asks me from time to time, I go, oh my God, who's running our country?
Yeah.
Anyway, so let's put that aside. And he said to me, can I make some recommendations? I said, what's that? He goes, look, can you get all of your clients to make a complaint to the local member, right? Because they need to hear what impact, because he had no idea. When he goes, look, I've heard something.
He's a politician.
Yeah, I can't remember what seat he holds, and I go, well,
the voice of the people, Sam, can hopefully overturn. I am conscious of time.
Yeah, sure.
Just one question, Sam. Look, it's very early. I saw it come through from Kim Turner. From what you know, and not holding you to it, right? Obviously, because it's only been 72 hours, right? Either what's the best way? What sort of advice would we? Not that we can give this sort of advice to investors, but what should we be aware as giving advice to an investor who's going to buy a property? Yeah. What would you be saying to them right now? And or how long would it take you to work it out? Okay, we've got to wait another 30 days, 60 days.
So the first, and the reason there's not going to be an answer for all, you don't have, you don't have one pill for all everyone's illness.
It's not one
because so the starting point is the first starting point is that individual investor, how do they derive their income is the number one, right? So if they derive it in salary and wage world where the income's been derived personally, that's going to be one set of circumstances.
Yeah.
If you're now dealing with people who are self-employed, who have the ability to structure their affairs in a manner that the income has not been derived personally, what all of this is pushing you to do, and if you think about it, it's actually quite smart. We're all concerned about the 50% discount going. They are effectively pushing you to work in an environment where you're going to run your future business and your future acquisitions in a company structure, which doesn't get the 50% discount anyway, or whatever discount, or any indexation moving forward. That's ultimately, if you think about it, when I keep racking my brain and going, how would I structure a new client that comes in with a new business moving forward, right? So when talking about someone that's self-employed, well, you definitely can't put him in a world of pain with a discretionary trust. You're going to have to flip the whole structure upside down to the point where it'll probably be a company that trades. The shares in that company, the shares in Trading Co are going to be held by Holdco. The shares in Holdco are probably going to be held by a discretionary trust. And then Holdco is probably going to be the vehicle in the group that's going to undertake the future investment activity. Because under that scenario, if you think about it, if Trading Co makes $100,000 profit and it pays 25 cents to the government, there's $75,000 left. It can declare a dividend down to Holdco. Holdco can then go off and invest in property or shares. The gearing will be at Holdco level. Now, what have you done? That all works with the proposed changes, but you're in an environment where when you sell those assets, you're going to have to forfeit any discount on any gain. Now, is that necessarily bad? And what I often tell clients is, because look, timing. Look, let's face it. We're all dealing with the same issue, and that is, you would all prefer the saving at the beginning of the journey than at the end of the journey. So if you can get the relief at the beginning, because it then gives you the ability to buy 1, 2, and 3 or 4 properties, then you're going to want to take the relief at the beginning and sacrifice the discount on the gain. Because historically, whenever you sit to somebody and everyone gets focused on, we're going to miss the discount. I get it. But what about if I said to you, you can buy that investment with money that you've only paid tax on at 25 cents in the dollar and not 47 cents in the dollar? That 22% gap, without showing everybody the mathematics, on every $1 million in after tax, it translates to a $500,000 saving.
Yeah, it does. Yeah.
Right.
Wow.
Because if you divide $1 million, because you got to buy that with before tax dollars. Sorry, you got to you're funding it. Sorry, you're funding it with after tax dollars. So if you divide $1 million by 53%, it gives you a figure of 1.8. If you divide $1 million by 75%, you end up with 1.3.
Yeah, so you're $500,000 in front.
Correct. So if you said, you've got to change your mindset and go, hold on a minute. If I can get a $500,000 saving in my income tax, that's another deposit on a property.
Yeah.
Right.
Yeah.
If I then get it right and structure it in a manner that I still get the gearing, so I trade out a trade co, declare the dividend down to Holdco. Holdco then has the gearing benefits. It all works, right? But that's moving forward. That's definitely going to change how people structure their affairs moving forward, in my mind, right? The next challenge that you have to be really careful of in Victoria, at least, is the next piece, is because in my history of doing this, and from my white hair, you can probably tell I've been around a little while. One of the things you never, ever had to plan for is land tax, because it was always such an insignificant thing. So you've got to blend that. So going back to, if someone come along and said, look, I want to own 10 rental properties over the next 10 years, I said, look, that's great. But we then have to give some serious consideration to, from a land tax perspective, would you buy them all in the same company? The answer is no, because the aggregation is going to kill you. And then you're going to get to a point in your time where the holding costs are just going to absolutely annihilate you. So so there has to be further thought, and there's a mechanism that even with these changes still works, where you could potentially hold by. Look, and we're going to get into some detailed stuff here, but there is a solution even under the current rules, where you could buy property 2, 3, 4, and 5 either under a bare trust arrangement on bare trust for Holdco, and then that each of those properties gets assessed for land tax at surcharge rates, but they don't get aggregated with your previous holdings, and that's probably one of the critical things where there's an opportunity. Look, I'm probably getting too deep, but
yeah, I think that we've got to leave that with the one-on-one accountants and obviously meetings. But guys, look, obviously, as we mentioned, I think Sam, as we mentioned earlier, we've got to learn the rules of the game, the changed rules, and then obviously on a personal level and on a professional level, how we can best advise ourselves and what our plans are moving forward. I've always said, guys, if you plan, just the best investment we can make is in ourselves. both in knowledge and awareness, and then of course in running a business and making sure that the business is profitable. And the more profit a business makes, you know, money takes care of everything, no matter what rules they put in place. And,
Correct.
you know, at the end of the day, we can't think about what it could be. We need to think what it is right now moving forward. And that's what it is. Selling more houses fixes everything. Absolutely, Richard. Absolutely, 100%. So
There's
can
a
we give...
question from Kim Turner about a rent roll. Would you buy a rent roll at this point in time?
Not
Question.
sure.
Most property owners will not hold their grandfather investment.
Not sure, Kim. At this stage, I'd wait. I'd wait till I get more information. And look, we're in the front line, right? So I'll give you an example, and this is why it's so important to be attending these sorts of sessions, and more importantly, our national sales meetings and so forth, to have a feel. If all of us, you know, there's 200 real estate agents or 350 real estate agents, you know, registered with Black Salt, but if we all said, suddenly over the next 2 to 3 weeks or 2 to 3 months, we see an influx of investors, right? I'd be buying a rent roll because the demand is going up and we're in the cold face. You should be able to sense it, right? If you see lots of investors because they're getting advice from their accountants and they've got the right structures in place and investment properties are moving forward, I'd buy a rent roll. If you see an exodus, if you currently hold a rent roll and 5-10% is increase in selling, I'd be hesitant. I'd be really hesitant because it's a huge investment. And or is the valuation of rent rolls going to decrease? Because no one's got a crystal ball on that, right? And I'll be more concerned about how I'd be going to your lender. I'd be going to Macquarie Bank if that's your lender or whoever it is, and getting a feel for what they say. And look, they do deep analytics and analysis. So we're always going to be able to get better information from the source. And if they've got a bigger appetite for rent rolls, they're not going to be funding rent rolls if they know there's going to be a 5 or 10 or 15 or an increase in shrinkage. Does that make sense? So just use some common sense there, right? Because no one, as we just mentioned, the politicians who put these policies in place don't understand the rules, right? They just make it up as they go. Team, really conscious of time. Can we just please give it up for Sam and for Rose? So a huge thank you. We have riveting conversations, Sam, with Sam all the time, and I thoroughly enjoy catching up and seeing it from a different perspective.
Sure.
Again, team, a big shout out to all our industry partners who support this. Big shout out to Rose. Big shout out to Sam and everyone that puts these together. I hope you found it informative. And if you did, please make some comments on Black Salt. I'd really appreciate it, and we'll get some more people into the movement. Again, thanks for joining us. Any last words, Arthur?
No, just to say I caught up with Sam last week. He didn't have a grey hair on him. Well done.
All good. Thanks, Arthur.
Again,
take care.
Team, thank you so much for joining us. Really appreciate it. And everyone, let's have a great week. Start selling some more homes. Richard. Be good.
Bye.
Thank you.
Bye.
Thanks, Anne. Bye.
Thank you all.